just touching on scalability and portfolio growth. How I've seen property grows, it has got three phases. The first is acquisition, and then comes the second stage is stabilisation, and then the third comes is consolidation.
Rishi Bajaj, welcome onto the show. How you doing, buddy?
I'm good, Aaron. I'm good. Thanks for inviting.
How does someone manage cash flow as they are scaling or building a property investment portfolio?
Some of the points is when you're buying property, it's very important to do the cash flow. Means, yes, you're getting the rent from the property, but you also need to see what's my maintenance cost, what is my council rates, what is my maintenance, repairs, and insurances. So these are kind of the cash flow that we need to analyze. That's the incoming minus the outgoing.
So good incomes, we've got equity, got the borrowing capacity. How does someone scale without, I guess, making mistakes?
See, number one is if you have that mindset of growing, that's very important. You need to have a proper strategy and a plan to scale. You might have good incomes. If you do your numbers, you say, yeah, you know what, it's making sense. This is the mortgage, this is the rent. I can fill the gap, but that's where the bank stops them.
How does someone in this big mid-pack move themselves to the top 1% in property investing?
The first thing, you need a great team around you for that, who can give you ideas of how to grow and what's your next move. People nowadays are feared of messing up than missing out. If something goes wrong with the economy or it doesn't rent out, they just start getting all those fears, and that also stops them from going ahead.
G'day everyone, welcome back to another episode of the Australian Property Investment Podcast. You've been asking the questions and I've listened to what you're asking. So if your questions are, how do I manage cash flow while starting out or scaling up a portfolio? This episode's for you. If your question is, how do I even scale a portfolio? This episode is for you. If your question is this a good time to be investing? This episode is for you. If you're keen to find out how an investor has built their portfolio and wants to share their journey with you, this episode is for you. I hope I'm going to deliver in terms of answering all those questions. In fact, I know I will, but I hope you find this episode helpful. Rishi Bajaj, welcome onto the show. How you doing, buddy?
I'm good, Aaron. I'm good. Thanks for inviting. How you been?
I'm great. Thanks for asking, mate. Life is good.
Absolutely.
I can't complain. Life is good. Mate, I'll tell anyone that listens, we live in the best country in the world. So this is a great time to be alive. I was watching the other day with the kids, watching this documentary about dinosaurs. I was like, imagine trying to be alive. Yeah, many, many years ago, we're trying to dodge saber-tooths and dinosaurs, mate. This is the best time to be alive, honestly.
Imagine running with them or just riding them.
Oh, dude. It's, mate, imagine living anywhere else in the world. So I say to anyone listening, the fact that you are able to listen, the fact that we've got access to this much information, the fact that we've got access to someone like yourself who's going to share their journey, share their insights as well, mate, we're privileged. It's an absolute privilege. Buddy. So thanks very much for listening and joining with us as well. I'm going to start off with that first question, and you probably get this daily because Rishi, you are a buyer's agent and also a property investor.
Yep.
How does someone manage cash flow as they are scaling or building a property investment portfolio?
Absolutely, mate. Let's just dig into it.
Straight into it, mate.
Let's not waste the time. People are eager.
I'll come to an intro in a second. I want to get straight into it.
No, that's good. So how to manage cash flow and scalability. And I've seen many of my clients who just get stuck at one or two properties.
Mate, spot on.
So I look at it in two different aspects.
Hang on. Let's say stuck at one or two properties. I'm going to say right now, they're not stuck because of equity. Because I can tell you right now, I'll reval properties, I'll find equity. You're going to go up to 90% against the property. So don't tell me equity is or deposits the problem.
I'm not even going there.
Right?
No,
that's what I mean, right? So I'm saying to a borrower, don't tell me that's the problem because I can go out to 20 different banks and get 20 different valuations. I'll find somewhere to pull and squeeze the equity from. So if you're thinking that's the problem, you've missed, that's not the problem at all.
Okay.
What I think what we're trying to say is though but you're saying I'll get to two properties. Now they're going, but I'm losing $100, $200, $300 a week to hold. Yeah, so that's the context. So buddy, keep going. Sorry to interrupt.
No, that's fine. So when we talk to clients about the cash flow and buying a property, see, it's very important. The bank can give you a borrowing capacity maybe up to $1 million.
Yeah.
But what is your holding capacity? Can you buy a property and hold up to that much? So some of the points that I discuss with my clients is when you're buying property, it's very important to do the cash flow. Means, yes, you're getting the rent from the property, but you also need to see what's my maintenance cost, what is my council rates, what is my maintenance, repairs,
interest,
waters, and insurances. So these are kind of the cash flow that we need to analyze. That's the incoming minus the outgoing.
Cool.
That will give you that end of the day. For example, if we're buying a property for $550,000, interest rate of 6%, I'm sitting there at a negative gearing of approximately 10K. I've not even taken depreciation in count. And this is before tax. Take out another 35%, 30 or 40% tax, depending on which bracket you are. That brings that down. So that gives you an analysis of your cash flow. The second thing, when you
how does someone do that cash flow analysis then? Because right now I'll do a borrowing capacity, I'll do a repayments, for example, then I'll effectively hand it across to a buyer's agent, and the buyer's agent does a property strategy, locate, negotiate, for example. The missing piece I'm finding is this cash flow piece. Is there a tool? Is there a template? What can someone do to work out how much in the red am I going to be potentially?
Absolutely. And that's when I work with my clients. We don't start at which area we should buy with.
Mate, spot on. You missed the point if you think about the area.
Exactly. I start, how much can you be comfortable in this uncomfortable situation? Which means 6%, I'm uncomfortable. 2019, 1.89, happy days.
Every investor was laughing. Yeah.
Absolutely. Now, we reverse engineer, which means we take an average price of the property. We take the average rent of the property that we're going to get, interest rates, we keep it approximately 6%, that's going to be forever as a linear. And then we take what's your acquisition cost, your deposit, solicitor's fees, pest and building, any land tax if you're buying in a different state. And then what's your management fees, what's your we just keep aside insurances, costs. So we use this Excel sheet for cash flow.
Okay.
And that gives us, and that also takes some assumptions that the property is growing for the next couple of years on a linear growth of 7%. We know Australian market has grown approximately 6 to 7% in the past 20, 25 years. And that's what we assume, that though there are markets that are even growing at 15 or 20%, some at 1 or 2, but we just take that, there's a 7% linear growth, there's a 4% rental growth. We take inflation also. And that Excel sheet drops down that end of the year to buy a property for $550 with a 7% growth, 4% interest, at 4% rental growth interest, and a 6% interest rate, I'm paying approximately 10% as negative gear before tax. If I take the tax out, can you afford that money?
Because the tax doesn't come week on week. The tax comes at the end of financial
year.
And so you've got to be able to hold for 52 weeks.
52 weeks.
To then get the sugar hit back at the end of financial year, right?
There are some accountants who would do on a monthly basis.
So what we're talking about is what? A PAYG withholding variation, or what are we talking about there?
Both of them over there. So they are either you can go with variation of PAYG, or then you just take that I'm going to hold $10,000 for the whole year, but that's going to be on a monthly basis.
So what, have a separate equity loan or something sitting there as 10K, or what's the strategy there, buddy? Sorry.
The strategy over there would be, again, you need to keep that buffer amount in your bank.
Okay, so hold 10K in cash,
exactly,
or equity, to buffer the loss.
The loss.
Okay.
And that's where we come to the next point, is that before even I plan of buying an investment property, I need to make sure that I've kept at least a rent worth of 3 to 6 months to mitigate my risk.
3 to 6 months of rent.
Think? Yes. Are you an aggressive buyer?
No, I'd say, look, I personally wouldn't hold 3 to 6 months.
Yeah.
I think I definitely have some conservative clients that will go, I mean, hey man, if you're buying a good quality investment property, do you need to hold 6 months? Maybe 3. I'll tell you where 3 probably comes into it. If you have an issue with the tenant, and then you need to go to like tribunal. And there's a period of time where it's like, until this can get sorted out, I'm carrying the rent and the repayments. Yeah. So I understand what you're saying.
So that's why, depending how aggressive you are or how conservative you are.
Yes.
Why this came? Very first client, when I was signing up a couple of years back, his first question was, "Hey Rishi, what if the property doesn't goes on rent?" I said, "Right, you're buying in a good growth area.
Great.
The vacancy rates are low.
Yes. We shouldn't be going without a tenant. Yeah.
We are doing it that day in, day out. He's a first-time investor.
Yeah.
He doesn't even know what growth indicators are. That's where we have to explain him. You've got to do a bit of hand-holding.
Yeah.
And that's where he gets the point. All right. And that's where I tell my clients that whenever you buy your property, make sure you have a buffer money kept in your offset account or separate that mitigates the risk of your rent.
Cool. I appreciate that. So back to your point around, hey, there's a spreadsheet here. Is this secret sauce, or do people have access to that? Do you think if someone wants to go, hey, look, how do I plug in these numbers, purchase price, interest repayments, holding costs, therefrom spit out with a negative number?
Yep.
Is there a tool? Is that template? I'm going to put you on the spot here. Sorry, buddy. Is that exclusive to clients that you work with, or how do people get access to a tool or a resource like that?
So yeah, initially what I used to do is it was exclusive to my clients. But now whenever I talk to people and if they're struggling, right, even if they don't sign up with me, I say, hey, this is a cash flow sheet. Take it, use it. If it's of help for you, then why not?
Awesome. Do you reckon we could offer that to people that are listening at the moment?
Absolutely. Why not?
Let me tell you guys right now, I did not warn you about that. Generosity, mate. Thank you very much. I got to say, mate, if you can solve that problem for investors, the generosity that you've given there will come back in spades to you, buddy. Because I got to tell you right now, even if I have people that are on some insane incomes, I'm talking 300, 400, 500, 600K incomes. When it comes to scaling a portfolio, the first question that I'm showing is once they get past maybe the second, third, fourth acquisition and it's all red, the first thing they're asking me is, hey man, how do I hold this portfolio when I'm like red across the board? And I'm like, okay, well, a couple of things. One, rates can come down.
Yep.
2, rents can go up. 3, your income goes up. But you need all that to kind of align to come out of the red and move into the green. And I think you and I know having, when you're in the game of investing for long enough, there becomes a tipping point where you move from negative geared to neutrally geared to then positively geared.
Yep.
But man, it's a period of holding on through this like desert of cash flow to come out to the other side where cash flow is not an oasis anymore. It becomes a reality.
Yep, absolutely. And that's what I said. It's when we're doing, there are 3 different aspects to this. Number one, when we're looking at property, we've got to spit out all the numbers. And that's where the cash flow comes in. Because today's cash flow are not forever cash flow. They will change. As you said.
Well said.
It's 6%, 5, 4, 8. This is going to change. But every year, there's one factor that people don't consider. Your rents are going up. Even though you're on interest only initially, your loan amount on 80% of $500,000 is still there. It's going to be stagnant for the next 10 years.
400K is a loan in 2 years' time.
Absolutely. But your rent is going by 4% every year. So you got to even keep that in consideration. And that's where 10 years down the line, you go and match that. Second thing I talked about was buffer money. Whenever you buy a property, make sure you have the 3-month or 6-month, depending how aggressive or how conservative an investor is. The other thing I tell to my clients, diversify your portfolio.
Okay.
Not only residential and commercial, but within residential also. All right, a step back again. When we're buying a property, we like to keep a balance between cash flow and capital growth.
Yes.
It's important.
I'm big on advocating for like you almost buy in pairs almost.
Yes.
Yeah.
Why? It's like yin and yang. So capital growth is happening, but for tough times, you need to have a good cash flow in that property also so that you're just not paying a lot from your pocket. Yes, we talk a lot about negative gearing. That's a different aspect. Let's not go there. Why it's important. So when you're building your portfolio, it's always good to also have an asset that are 2 dwellings on it that gives you a higher cash flow.
Are we talking about grannies, for example?
Granny or duplexes.
Duplex? Okay.
Yeah.
Yeah.
In that way, you can have one property where you're sitting at a lower yield, but it's a really good high growth capital growth market. But you can also diversify and fill that gap by having a different property with a good cash flow. So that's where you diversify it.
Yeah, okay.
And one thing very important when we're doing cash flow, and I tell to all my clients, it's a business. You have invested. This investment property is a business now. All right? When you buy investment property, your deposit is your capex and your operating costs are daily expenses that are happening over there. Always keep 1% of the property value aside. Not that you're going to spend it on expenses, but just think that 1% of the property I've kept aside as an expense and maintenance. Why? And that happened with me. When I bought my last property, I bought in Bundaberg. We did the piston building. Everything was fine. Everything was okay to go. After 2 months, I get a bill that the garage motor has broken. All right, $500 bill. I was like, oh no, not a great investment. But today, if I look 2 years down the lane, the property has grown.
So how much do you reckon it's increased in value by, buddy?
I would say easily in percentage, it's gone by 25 to 30%.
25 to 30%.
Yep.
So for you to pay $500 for a garage motor, some repairs and maintenance along the way, when you zoom out and you go, hey man, I've made 25 to 30% on the asset.
Yeah.
Yes, it's taken some extra chipping in, but man, you couldn't manufacture that. You couldn't save that. You couldn't earn that, for example. It's like you've done nothing.
Yeah.
When I say nothing, you actually had to buy the property. But while you've been sleeping and going about your life, this has been compounding and growing to the tune that's earned you. So I think that's where, again, if you're trying to take what I'm trying to give the lesson in this is overlook the $500 for the motor, overlook the $1,000 for the swimming pool. Hey man, if you're buying a house that has an electric garage door, the motor at some point has to be replaced. If you buy a house with a swimming pool, it has to be filtered and cleaned at some point. So expect it. Don't be surprised by it. These are homes, and I own my own home. And I can tell you at any given point, there's a plumber coming, there's a gardener coming, there's something happening in this house to keep it going.
Absolutely.
Because that's just the nature of owning property and real estate. And if you don't like it, then if you don't like that part of it, then maybe property isn't for you. And we're going to talk about the different types of investors, those ones that thrive and succeed versus the ones that start out and fall off the wagon. I feel like the ones that fall off the wagon, the ones that are going, geez, man, I didn't expect that I'd have a maintenance of hot water. I'm like, geez, man, what do you think? There's a house with running hot water. You need to change the hot water tank at some point.
Yeah.
Yeah. Cool. Sorry, mate. Keep going.
No. All right. So what I was saying is, okay, coming back to it, you have to keep that 1% of the value of the property. And I'll tell you why. Two things over here. Number one, it's a business. That's your operating cost. Mm-hmm. And number two, that takes away your mindset, which means it's a property. Mm-hmm. You're going to get a call from a plumber. The sink is not working. The flashlights have broken. The windscreens are, the fly screens have broken. Something will happen. So if you keep that mindset, oh, I just got a $200 bill. Oh, I just got a $500 bill. What I do for my clients every 6 months, I call the broker and I say, hey, can you please give me a valuation of this property?
Nice. Yeah.
And that's kind of a goodie. And then they feel good. Yeah, great. We did this investment. Then they're not worried about those small bills are coming. But at the same time, if you put 1% aside of it, happy days. You don't need to stress about it.
I mean, 1% you could live with, right? I mean, you could live with a 1% buffer. That's cool. I think it's, in my business, I call it a war chest, right? Mm-hmm. Every business would have a war chest where like, I'm not running paycheck to paycheck. That'd be a very bad cash flow business. And so if you treat your portfolio like a business, then you're not going to cut it too close to the bone. You're going to have something left over for emergencies. What does Scotty Pape call it? Barefoot investor. I don't know, some account that he calls it, but yeah, sleep at night factor, mate, whatever you call it. Let's roll with. Okay, so we've talked about like cash flow becomes the Achilles heel for investors scaling up. Here's a tool or a resource. So you shouldn't be surprised by the negative cash flow. And at some point you can see a tipping point that you're going to move from heavily negative to a little bit negative to almost neutral. And then you know the sweet spot that you're working towards as well. That's very helpful. Thank you, Rishi. The next part then comes to scalability. So good incomes, we've got equity, got the borrowing capacity. How does someone scale without, I guess, making mistakes? Because when I guess the question behind the question is, and you and I see it with a lot of brokers, I'll put everything into personal names, for example, and that's like, that's it. Borrowing capacity is done and dusted. I can't move on. And now they've got to maybe offload a property to free up borrowing capacity. How does someone scale without making mistakes? And this is where you can let the cat out of the bag with like mistakes that you've seen, mistakes that you've made, for example. How does someone avoid those scaling issues?
See, number one is if you have that mindset of growing, that's very important.
Yeah.
You need to have a proper strategy and a plan to scale. Well, we have heard stories. Yeah, you go to the bank after buying 2 or 3 properties, or your BDM or the bank will say, sorry, you're capped up. You can't have any more borrowing capacity.
Yes.
You might have good incomes.
Yep.
You can, if you do your numbers, you say, yeah, you know what? It's making sense. This is the mortgage. This is the rent. I can fill the gap. But that's where the bank stops them. So a couple of things I've seen where if you have a good accountant or a good broker who can make a good structure for you. So we've seen things like trust structure or company structure, where you can start investing in different structures that can be properly. The other thing in the past years that we have started seeing is using your SMSF.
Nice, spot on.
So that is another.
You know where I find SMSF's probably the most underrated part? When people want to buy their owner occupied and still keep investing, right? So for me, I say, yeah, mate, you can have your cake and eat it too. And people almost lose their mind and go, what do you mean? I thought I could only do one or the other, buy my own home or invest. I was like, hang on, you buy your own occupied and then you go and buy an investment property through your self-managed super fund. You've had two bites of the cherry, now you got two assets. And I feel like that isn't a conversation. It's like you have to rent vest to invest, or once you buy your own rock, that's it. You can't buy an investment property. Whereas I'm like, you can actually have your cake and eat it too. And that's probably where a well-articulated, well-planned out strategy, to your very point, having a strategy helps, which means you then need to go back a step and going, that's where you need a strategic team around you going, they can almost preempt, this is your game plan, or they've asked the questions around, what are you looking to do? Tell me what you want to do. I want to do this and that. Okay, great. Let's make it happen. Sorry, mate, keep going.
And for this, I'll share a very good example. So a very good friend of mine is a couple of years back, we were having a chat and, during our office time, lunchtime, all we talked about was property. Good old days. So he wanted to buy an investment property and he was not sure because his budget was limited. And that's when this idea came, because he was living in a great suburb in Ottoman, close to his office, kids' school. He's happy, but he can't afford there.
Yes.
Or he will end up with an asset type, which we call an apartment or townhouse, which he didn't want to. That's where he started the idea of rent vesting we just talked about. So he's bought his first property in Queensland, second in Central Coast, and now he's looking at his third one. And he's still renting, but his portfolio is growing now. If he had done two things, number one, he had either bought an apartment or townhouse, which is still fine. I'm not saying apartments are wrong things to buy. They're good things to buy, but don't expect to buy an apartment and grow your portfolio or have a capital growth out of that.
Look, you could, but I think where you said there is he's got kids.
Yeah.
And at some point, you will outgrow an apartment with kids.
Absolutely.
And I think that's the hard. I have people that are in 3-bedroom houses that are outgrown it with teenage kids, and they're like, man, we can't fit in here anymore.
Yeah.
Some cultures will do it.
Yeah.
Some people can do it. That's cool. But I say majority of people will outgrow the apartment, which then they've got the mortgage. They're going to upgrade, which then means they take on a bigger mortgage.
Yeah.
Which then takes them out of investing as well. And you can kind of see the dominoes are starting to fall here a little bit around the strategy. Sorry.
No,
I keep interrupting, buddy.
It's good, man. That's what a conversation is. We don't have the emoji of putting your hand up, do we? So, as I said, with apartments coming back, they're not bad, is it? But if I compare them, how the houses have grown in the past 10, 15 years as compared to how apartments have grown, that's a big leap.
Yeah.
And that's a big gap.
Yeah.
But then if you buy that and you expect to grow your portfolio and equity out of it, then we're not talking portfolio strategy. We're just talking personal decisions over here. So coming back to that example now, because if he had bought an apartment, it would have grown, but not, would he have been able to buy 2 more properties? Maybe not.
Yeah. You'd be stuck, right? That's where you talk about, hey, 1 to 2 in properties, owner occupied, large debt service that.
Yeah.
1 investment property, then hemorrhaging cash. That means there's a bit of resentment going, we should be paying off our home loan quicker.
Yeah.
This investment property is sucking up our cash. You're stuck with borrowing capacity. So even if it's increased in value, what I call a frustrated investor, you've got equity, but you don't have cash flow to buy the next one, borrowing capacity.
Or he would have done nothing and kept waiting.
There you go. Well,
probably hasn't performed.
Like
carrot dangling.
Yes. So probably not performing then equals opportunity cost.
Yeah. See, when it comes to scalability, this is touching on scalability and portfolio growth, how I've seen property grows, it has got 3 phases. The first is acquisition. Buy as much as you can, as quickly as you can. That's it. Why? The compound growth of 3 properties in 5 years is going to be more than buy them in a staggering of 10 years.
Yes. Yeah.
So that's acquisition. But again, at the same time, not hitting you financially badly, which means that I don't want you to buy 3 properties in 5 years and all you're doing is just eating baked beans from a can. You need to even maintain the cash flow to maintain that life balance. So that is acquisition. And then comes the second stage is stabilization, which means you have done the hard work, you've done the deposit, you're paying the mortgage, you're taking care of the house. Now, time is doing the heavy lifting. The economy is raising the house prices.
Yes.
We're doing good. And then the third comes is consolidation, which means the property journey of growing is approximately 15 to 20 years.
Yeah.
First 10, 15 years is acquisition, stabilization, then consolidate, which means I've got 2 or 3 properties. I sell one, I bring my home loan down, then I use that equity to invest again.
Yeah.
Rinse and repeat. That's a very good way of going into scalability of your portfolio.
Yeah, nice. Well explained as well. I think we'll just keep coming back to this, I think, in our chat, which is give us the strategy. So when someone's strategy is, I want to buy 5 properties, it's like, okay, cool. What outcome are you looking for example? I think that's where we start to unpack this with people that obviously you talk to in your sphere and people that I talk to that, reach off the back of the podcast going, they've either been told no by their broker or their bank.
Yep.
And so they're feeling a little bit despondent or rejected. So they're lacking the clarity. But there's this ambition within them going, but I feel like I can scale the portfolio. And I said, right, come to us, work strategically through what I present a loan strategy. Here's what you're capable of doing. So here's your borrowing capacity. If they've got existing properties, here's your equity position. And then we go, right, what does that acquisition look like in terms of scaling a portfolio? With the bottom line effectively going, well, here's that cash flow. Yeah, which is where your spreadsheet will come in handy as well. And then once you're armed with the numbers, the 2 outcomes that I'm shooting for is confidence and clarity. If you know what you're doing and why you're doing it, that absolutely helps. And then if you have the clarity to go, hey, here's the type of assets I now need to put into my portfolio, as opposed to I'm going to buy in Melbourne, Victoria, like regional, because that's a growth market. That's not the strategy. Yeah, buying in Melbourne is the outcome, but buying a high growth location, cash flows at 4%, like you said, for example, but I want to use this to piggyback to then buy my next 3rd, 4th, 5th investment property. That's the strategy. Yeah. Not buying in Melbourne. That's not the strategy. That's the outcome. And so that's where I want, if you're listening, that's where I want the conversation to go to is tell us what you're looking to achieve. And let me tell you now, I have had people come to me where their broker has said, that's ridiculous. I was like, who are they? Or the buyer's agent says that you shouldn't be buying that many properties. Who are they to say, hey, be the dream killer? Mate, I spoke to someone the other day, our goal is 40 properties in the next 5 years. They can't tell anyone. They haven't told anyone. I only told myself and their partner, and that's it. There's no one else they can confide in without someone kind of balking at that idea. I was like, if that's what you want, here's how we work backwards from that. And I'll give you an idea how I strategize that. So it took 40, halved it, got to 20, halved that, got to 10, halved that, got to 5. So the first thing we need was get to 5. Right? 5 will then double. There's compound, like you said. 5 properties now compounding. It gives us the equity to go and buy the next 5. Great. Now we've got 10 that are compounding. That gives us the equity to go and buy the next 10. Yeah. And so when we're talking about scalability in your portfolio, if you can just take it one step at a time, know that there's going to be some red light, some red in the portfolio going, you're going to hemorrhage for a bit. But once you cross over, it's like, hey, there's a portfolio that's compounding in value, but also giving me cash flow. There's a magic that tends to happen. And that's probably where I want to unpack your journey a little bit, buddy, to get to this point. Take us through. How have you started out? How have you scaled up? And how have you succeeded in the game of property investing? What does that look like today?
Well, that goes decades back, I would say. That's in 2001. That's when I moved to New Zealand.
Right.
Did my studies over there. And
you moved from India or wherever you...
From India. Yeah. But even before that, I grew up in Nigeria.
Oh, wow.
Yeah, my dad was in the army, so he was traveling a lot and spent 10 years in Nigeria and came back to India and then in New Zealand.
Yeah, right.
And that's back in 2005 or 6 when I got my dream job working for one of the best oil companies, Chevron.
Yeah, right.
As an IT analyst. I think I'd scored everything. I was happy.
Yeah.
But then, my journey didn't start then, but I'm just trying to make a way. So where I got the flavor of property is that back in 2007, I was like, I've got my job. There was nothing hustling much to do. like you're in uni days, you're doing 2 jobs, you're running there.
Studying, working, partying, everything.
Absolutely. And then now back in 2006, okay, I've got this great job of working for an oil company, still single, but all right, nothing much to do on the weekends now.
Yeah.
And that's when I saw the signage of open homes on the streets. And then I met my family, my aunts and family, and I said, why don't you buy property? And I said, well, I've not done any saving. That's okay. You can always start somewhere. And that's when back in 2007, I bought my first property.
Well done.
Then 2009, I bought my second property. And that's how I built my portfolio in New Zealand.
Wow.
Now, coming fast forward, 15, I moved to Australia.
So 2015, you moved to Australia?
Yeah, in 15.
You got 2 properties in New Zealand at that stage, or have you built?
4.
4 now in New Zealand. So between 2007, over an 8-year period, you've bought 4 properties.
Yep.
Cool.
Then fast forward, 2015 came here, again within the company, started working with Caltex, oil company. I always loved working over there. It's a great place to work. Now, my property journey, how that started was 2019 when COVID hit.
Okay.
I lost my job.
In oil?
Then I moved from different. Then I've worked for Caltex, then I worked for Westpac, and then ANZ, and then CBA in the end. So changing different jobs. But then in 2019, when COVID hit, then I lost my job.
Okay.
And that's when I realized that, hey, I don't have any income coming in. Let me fast forward myself 30 years from now on. I've retired. I don't have any income. What am I doing now?
Right.
That is when lightning struck me.
This is. I'm just going to stop there for a second. Every episode, I just keep coming back to this. If you're relying on your income, mate, that's an unsafe proposition. Yeah. When you are reliant on your income, which sounds paradox because you need your income to go get borrowing capacity, one flick of a pen and you're gone tomorrow. And I've seen it. I've seen it this year. The amount of clients that I've had that have been made redundant. I'm like, this is a wake-up call. And maybe this is the wake-up call that someone listening needs, is if you keep trading your time for a paycheck and you have no assets to your name, no income-producing assets to your name, you need to invest in property. You need another source of income. You need another stream of revenue, for example, because if your income was to go tomorrow, what have you got? And it sounds scary because how are you going to service the mortgages, for example?
Yeah.
That's another story. I feel it's another podcast altogether, for example. That's what we talk about, maybe having the buffers, the 1% buffer, the equity sitting there, whatever it is, savings, Scotty Barefoot Investor, sleep at night factor account, whatever you call it, war chest. That's where you have that money there. So maybe we've solved that question, but it's the whole important thing is all your eggs are in one basket, which is your sole job.
Your sole job.
Now you have to crick without a paddle sometimes.
Yeah. And like when we talk about diversifying your assets, right? Buying different type of assets, being residential or commercial. I'm not saying that you have to diversify your income and work at 3 different companies, but you have to diversify your source of income. And that's when I realized, and then I said, wait, I've got 4 other properties. Okay. Some did good, some did not. Scalability.
Yes.
So maybe coming back to when we're talking about scalability and strategy, what's stopping? Because we need to buy in markets. We need that when we're buying properties, it's important to have that momentum properties. Okay. And that is where it moves you on. But what moves a momentum property is a foundation property.
Yeah. Oh, yeah. It's exactly the cornerstone. The first one's your cornerstone.
Absolutely. So you have that foundation property, and then you start building on that. And when we say it's not necessarily that foundation property should be in a capital city, that foundation property should be where which is growing good, giving you equity so that you can buy the next, second, and the third. Because by the time you reach the third or fourth property, maybe your borrowing capacity might go down. That means, you know what? We can't go more in a hotspot or seller's market. Let's go in a buyer's market, which means I'm buying at a low price, but it has a full growth cycle to go ahead.
Yes.
Because my hotspots have already done the heavy lifting for me. They've given me enough equity. That's where the strategy of scalability comes in. What I did was a mixed bag. 20 years back, I wish there was something like portfolio planning and strategy.
It was just buy a property.
Exactly.
That's the strategy. That's what I mean. Sophistication wasn't there. You went to maybe a few seminars, and they were selling product off the back of that. There was a few meetups, I reckon, that I went to. But there's nowhere near the prevalence of information. And I say that even now, like there's still podcasts, videos, courses, and yet investors are still making mistakes. So this isn't a foolproof strategy. It's like, hey, if you listen to this podcast, you do this course, you buy this one and you use this BA, you're going to get the magical outcome. This is a art. It's not a science around investing sometimes, right? It's sometimes it's the actual property that has an issue. It's like you would not have seen that coming with all the due diligence, with all the data that you've done. You've got to accept that this is not an exact science. It's part art as well. Yeah.
So So I had a look at my portfolio. I got some properties, and I was talking about the 3 properties that I had. Out of 4, the 3 properties were like hardly within a radius of 500 meters to a kilometer.
All right.
We're just buying property. That's it. We never thought about it should be somewhere else. Somebody's going to manage it. Why? Oh, I'll save my management fees. Duh. Think about the capital growth.
Totally.
So you're trying to save a penny, but you spend a pound. That's what happens. You got to look at the bigger picture.
Yeah.
So again, back in 2019, that's when I realized, okay, I've got some good assets, some not good assets. How can we fix them? Then I started listening to some podcasts. Started hearing about real estate. That's where we invest in. That's the thing that grows. I did not know much about earlier Australian regional market at that time. That's when I started, because it was all about Melbourne, Sydney. That's it. Then I started, opening my mindset, started looking around. And I ended up doing a real estate course.
Oh, no.
So I'll become a real estate agent. I did that. Great. It's a great course. Outside all the real estate agents, like you all guys are really great. I work with lots of them. Yeah. They're really, some of them are gem of people to work with.
Yeah.
But 6 months in that, every weekend, doing open homes. And I was like, wait, you have one seller. He has 5 agents bidding for him. And this poor buyer, I'm seeing him coming every week and he's not getting a property. And then I was listening to these podcasts with buyer's agents. I was like, you know what? I think I should be a buyer's agent. That's when it hit me.
Cool.
Strike me. So that's when I started doing my course of buyer's agent, understanding the concept, understanding myself as a buyer, what mistakes that I did. If somebody would have guided me then, how much better would I have done? And then now, rest is history.
Cool. Good one. So if you don't mind me asking, so you had properties in New Zealand, you've come here, bought properties in Australia as well. Can you share a little bit about what the portfolio looks like from where you started to where you are today, buddy?
Absolutely, mate. Absolutely. I would say I would just not do talk to talk. I'll walk the talk.
Okay.
I want to be transparent.
Yeah.
And I have done some mistakes. I have burned my hand, but I've learned it.
Yeah.
Absolutely. I've learned it. I've got a total portfolio of 9 properties at the moment.
Great.
And that's what I've done. Diversified, residential, commercial, SMSF.
Lovely.
That's all been diversified. And that's what I have been learned. There are 2 ways of learning. That you learn from others or you burn your hand. I've done both the ways. So I don't want to burn my hand more now. And I've learned from myself and learned from others. And my portfolio has grown in the past couple of years.
Yeah, nice.
Some properties have grown by even 40-50%.
Nice.
That's probably I'm talking about. But that has given me resilience. That has given me experience. And that's when I talk to my clients and I explain them how this can be beneficial to you. If you want to buy a property, like this, I was having a chat with a client. Hey, I'm going to buy this property. I'll sell it in 1 year. So I don't think so. I need to buy it. I will not earn much. I said, mate, number one, it's a long game. Don't think of selling it in 1 year. But even if you sell it within 1 year, you just have to do your maths and numbers. It's better than doing nothing.
Correct.
Yes. Your deposit comes back. Your stamp duty goes away. Whatever fees you're paying, that is amortized to the price of the property. And whatever the difference is, you get 50% CGT discount. The rest comes to you based on your tax. So you're still doing something.
Yes.
But trust me, I said, 1 year down the lane, the moment you see your property value going up, you will not sell it. Because that will make you more confident. And that's how I just created my portfolio.
Very good, buddy. Sydney, do you rent? Do you own? What's your current living situation?
Yeah, I own my own property over here.
Okay, great.
Yeah. And that's when I was buying. So I was living in when I moved here, I was living in a suburb known as Castle Hill.
Yeah.
every time I was missing to buy a property, either by 50 grand or 100,000, 50 grand or 100,000. with the mortgage broker, with the bank, I was not able to. I didn't meet you maybe at that time.
I told you the same thing, buddy. You're still falling short.
But then what I did is, rather than see, that's the whole thing. People talk about hotspots. I rather buying in Castle Hill, I bought it 2 suburbs away from that, and my property has doubled now.
Yeah. Oh, look, it's not the Sydney market only. I think it's the Australian property market. It's very suburb fickle.
Yeah.
Very suburb fickle, man. Like you could buy Castle Hill. For those that know the area, great, great blue chip area and the Hills district. You could probably go 10, 20 minutes down the road and buy Borkham Hills, Seven Hills. You get bang for your buck.
Yeah.
But people want to live in Castle Hill.
Yeah.
Like they want to live in West Pennant Hills, right?
Yeah.
People upgrade there. So Seven Hills, Borkham Hills becomes a stepping stone into somewhere like Castle Hill.
Yeah.
Yeah. That's why the growth in that market probably outpaces some of those other surrounding markets as well. So yeah, I think you're right, man. And to buy into that market, it's worth stretching yourself. Yes. And that's why I say you got two types of purchases. You either buy a stepping stone, which is you get into, say, a market like Seven Hills and you step into Castle Hill.
Yeah.
Or it's a stretch property. So stepping stone or a stretch, and stretch means, hey, we're gonna spend the extra 100 grand to win at auction now.
Yeah.
But we're in the area that we want to be in, and we know that's the spot to be buying. Yeah.
Yeah. And see, that's that all comes with experience, and that's what I talk to my clients is there are 2 aspects. And when we're talking about, either you can buy a house now, and then you got to wait a couple of years until you get the equity and start with your investments, or then you can do rent vesting, buy investment properties down the lane, and then a couple of years down, then you can make a decision what you want to do with your equity now. Because once you have an equity down the lane, then you can make a plan. What do I want to do? If not today, you can just think 10,000 things down the lane. You do not know what's going to happen.
Yeah, correct. Thanks very much. Look, I mean, thanks for sharing your journey. I know it's obviously very, you're open with your numbers, so I appreciate that. You've shared your journey on Pizza and Property. You've shared your journey on smart property investment. So that's why I felt comfortable to poke the bear a little bit, ask for some numbers. So thank you.
I hope people have not got bored about it.
No, mate. And that's what I say. People, it's like, hey, you got to go to someone that's been there, done that. Hey, if you're listening, own your own home and buy 9, have a portfolio 9. You're someone that people can tap on the shoulder and go, Rishi, how did you do it? Can you help me?
Yep.
And that's what InvestorWise, your business now, kind of lives and breathes. Yeah.
Absolutely.
Yeah. Cool.
Absolutely.
Thanks very much. So we talked about mistakes you've made. So we've spoken about how you concentrated risk. You bought here, for example. What are some of the other mistakes that you've made that on, looking in hindsight? And we've all got to make it. We've all got to make some mistakes so you can learn from it. But what are some of the other mistakes that have come up on your journey?
I would say the very first mistake I did was, the good thing I did was I had the financials, I had the deposit, I bought a property.
Yeah, cool.
I didn't do a due diligence.
On the property?
Yes.
You bought? Okay.
On the area.
Okay.
I just bought it. On the property, yes, we did the Western building.
Yeah, when you're young, you don't know what you don't know, my friend. Anyone that's listening, I just thought, get in the market, get in the market. I bought a house opposite a cemetery on a busy highway. It's crazy.
Mine wasn't a highway, not opposite a cemetery.
It was terrible. And my second property was overlooking a rail, like a rail line station. Crazy.
So yeah, that was one of the biggest mistakes I did. Because I should have done due diligence, and if I had done that, I would have held on that property for a bit more longer time.
Okay.
Yes, it was taken away, it was sold, but then if it just started on, that compound growth had to come. So that's one of the biggest mistakes I did. Yeah. The second mistake, I would say, it goes a couple of years back, is in a property journey, it's not only acquisition, it's consolidation, which means a time comes when you need to sell a property.
Yeah.
So back in 2021, this is one of my properties in New Zealand. It was a prime time. I should have sold it. I didn't. Maybe you can call me a property hoarder or what, but I said it's not easy to make an asset. It takes time.
Yeah.
I said, you know what? Maybe the market is here. It will be stagnant. It will grow.
But you only know that's stagnated in hindsight. At the time, like if it's increasing, that the market's still rising. It's like there's more to come. There's more to come. So you actually don't know when it's going to top out and when the perfect time is to exit a market.
Yeah. And because of that, I got a double hit. And that's what I said on Pizza and Property also. Why? If I would have sold it at that time, the property has been stagnant for the past 3 years now. It's not grown. If I would have sold it, I would have taken that money and I would have invested in another property that would have grown.
Another growth asset. Yeah.
Yeah. So, and I would say one of the other mistakes was just having, I would say, more of a clear strategy when I'm investing, just not buying all the 3 properties where I'm just living. I would have diversified it. So it is one of those things, have a proper due diligence I should have done.
Yeah.
Consolidation means I should not have been emotional. It's just an asset. It's a property.
Make correct.
And strategy. So yeah, these are the couple of mistakes that I'll always share with my clients.
Yeah, look, I think that comes with a bit of experience, a bit of life learnings as well.
Yep.
Hindsight's a wonderful thing where, I think for a lot of our clients, I look at people that bought in the Hobart market and there's a point that it peaked.
Yeah.
And they said they'll hold on for a little bit, right? It's like, I think you got to get comfortable with exiting a market. Some people think, no, I've got to buy and hold forever. And that's cool. That can work. And markets can, chop and change and find a second wind, for example. And that's where that second half of compound and, the second cycle, the third cycle of compounding is where you make, your windfall. But other times it's, hey, when do you cash your chips in? And that's maybe when you go back to the strategic side of buying property, or the strategic side of your lending. But if by holding, what does this restrict me from? Or do I have the ability to then, sell 1 but buy 2 or 3? Does that free me up, for example, as well? So it's never linear. I think you spoke about something linear before. It's never linear in that sense. I think for us, it's going. Everyone's got different start points. I've got some that are starting at 45, 50, but others that are starting at 25. Very different strategies there as well, right?
Yep.
I want to come back to, if you're listening, it's probably hard to, but if you can imagine this, I'm drawing a bell curve, right? And so you've got this bell curve. It's Pareto principle. It's 80-20. It's anything in life. Like if I look at the mortgage broking industry, I think at last count, there's 22,000 mortgage brokers. And pretty much you've got to be in that top, 1 to 5% to really make it worth your while. Yeah. So maybe 2,000 brokers are really doing well.
Yeah.
And anyone below that's probably writing some average mediocre numbers. So it's a classic bell curve where you got top 1%, 5%, for example. Got this big mid pack of maybe people that have potential, but it's going to take something for them to move forward into that top percentile. And you got this lag group that probably shouldn't be there. Or they're new in their journey. It's the same thing I'd say with property investors. So you got this classic bell curve. We're saying 1 to 2, 3 properties is the bulk. 85% probably sit there.
Yeah.
3, 4, 5, 6 investment properties. Then you start to get into the top 1% of property investors as well. I'd love to see that ATO data set's coming back from like 2021, I believe. I'd love to see when they update that because we keep peddling these numbers. I dare say that we're going to see a couple more percentage, even if it goes to 5% that have 6+ properties.
Yeah,
we're still talking about the top 5%.
Top 5%. Yeah.
Yeah. So my question's coming in a second, but that just gives you a bit of a vision or an illustration of this bell curve. It's the same in any organization. Bell curve of talent. You have your high performers, you've got your potentials, and you've got your talent that probably just need to be exited or moved on to find a role that's better suited to their skill set. You take cricket. I'm sure you watch the cricket just probably as much as I do. Not even 1% of cricketers go on to earn a living from cricket or any sport for that matter, rugby league or soccer, for example. And you got this mid-pack that enjoy it, love it, could potentially they trained or made it their vocation, they'd make some money from it. And then people that just do it for the love of it or won't ever make it professionally as well. So if I come back to the context of property investors, how does someone in this big mid-pack move themselves to the top 5% and then to the top 1% in property investing?
Yeah. See, the first thing, you need a great team around you for that. All right. You need to be surrounded by some really great team who can give you ideas of how to grow and what's your next move. Just not give you a cap that you can't go anymore.
Yeah.
The most important thing, and I'll come back to the strategy.
Yeah.
But people nowadays, what I've noticed, are fear of messing up than missing out.
Okay.
They are feared.
Say that again so people will.
Sure, man. So nowadays I've seen clients, they are more fear of messing up than missing out.
Mm.
So they think, yes, I've got 2 properties. I've got 3. I've got 1. I should just stop here. Because if I start scaling my portfolio, if something goes wrong with the economy or it doesn't rent out, they just start getting all those fears.
Mm.
And that also stops them from going ahead.
Mm.
So for scalability, as I said, it's very important having that great team around you. First of all, is your goal to have 6 properties? That's very important. Do you want to be in that top 1%?
Sure.
Do you want, if you're in the office, do you want to show you're just not here for 9 to 5? How are you going to outperform? What's that extra in you?
Mm.
Yes, you can go to the gym. Yes, you can do 100 push-ups every day. But do you have the ability to make it 110, 120, 130? Having that compound growth every day. That's up to you. So that's very important when I talk to my clients. What is your end goal? Yeah, everybody wants capital, but do you have the ability of taking that risk also at the same time? So for them to push that, you have to have that strong mindset. It's very important. Number 2, they should be surrounded with some great team, some great broker who can help them with their loans. Yes, we have the top 4 banks, but they are different other finance institutes also.
Oh, mate. The top 4 banks are not enablers for investing and building a large portfolio.
Yeah.
And I say that I do a lot of work with the big 4, even the big 5, for example. They will get you to a certain level.
Yep.
And then you've just got to at some point look beyond the name of the bank and look beyond the rate and just go, who's going to give me the money to go and buy an income producing asset?
Yep.
And I wish more people looked at an investment loan or a home loan the same way they looked at a car loan.
Absolutely.
Dude, no one gives a hoot who their car loan is through.
Yeah.
They don't care what the rate is. They don't care what the fees are. They just want the car.
Yeah.
They want the BMW or they want the Audi, whatever it is. And they don't give a rat's about the terms on this car lease, novated lease, whatever. But they'll go through the investment loan or home loan with a fine-tooth comb. I'm like, man, you're buying an income-producing asset. The car is a depreciating liability with a balloon payment at the end of it. And you don't care about that, but you're majoring in the minor. You miss the point. And then again, we talk about this bell curve of investors. The top 1% of investors, the top 5% of investors don't even have a novated lease. They don't have a car loan, for example. Like that's what we're talking about. If we really pull the hood back on what the successful investors are doing, you mentioned about the team. They're not carrying around rubbish debt like credit cards, like car loans, like novated leases, for example. They're factoring in the negative cash flow that comes on with investing. I'll let you keep going because I'll get off my soapbox.
And see, coming back to that car, I'll tell you.
Yeah.
I have never bought a first-hand car in my life. Only 2 years back, after having a portfolio, I bought a first-hand car.
Yeah, right.
It's not about show boasting and all that stuff. You got to keep it simple and basic. What are your priorities? My priority was when COVID hit me, all right, I want to create my portfolio. I want to make sure when at one stage I have, it's not about financial freedom, but it's a freedom of time I can spend with my family, with my kids as they're growing up. The time will not come back again. So that was very important. So what I'm trying to say is, what are your priorities? So yeah, my priority was to build my portfolio, and that's where the car thing came in. I bought a new brand new car only 2 years back for the first time. So yeah, it was something great, but fine. It was nothing. It was. I still think I would have used that money to buy another property.
That's mate. I got 2 very mediocre cars in my driveway, and every single time I go to, should we upgrade? It's like, just put that money into property.
Yeah.
Put that money. Man, our kids are 6 and 4. I buy a new car, they're going to trash the hell out of this new car anyway. Man, I spend my time being neurotic about a car. Versus, hey man, go and buy assets.
Yeah.
Go and buy property. In 5 years' time, then go on like you've done, like in time, then you can go and buy the toys.
Yeah. You need to treat yourself at times.
I agree.
Yeah.
Celebrate, man. It's like, but the celebration doesn't have to be, hey, we've got 2 properties. Now we're going to go buy a new car. The celebration could be, hey, it's a weekend in Sydney. It's like a weekend at a hotel. We're going to celebrate in a nice restaurant, for example. You could wrap the celebration up like that. It's not too expensive, but it's a marker of success.
Yeah.
And then the next celebration, I must take it to 5 properties and I might buy myself a nice watch.
Yeah.
10K, 12K, for example. You're not spending $100,000 on a car because you bought 2-3 properties. Man, you haven't made it that point.
And that's exactly it. A friend of mine, if he's listening to this later on, is that he bought a brand new house for himself, which is good.
Yeah.
And then he wanted to buy an investment property, but he said, I'll buy a BMW first.
No, you buy a brand new house, you buy a brand new car. Simple.
And then I said, who's your broker? I called around, make sure you don't give him a loan for his car. He's going to buy an investment property first, then he will buy his BMW.
Let me be clear. This is not me angling or fishing for business. I don't finance vehicles in this business. I do not finance vehicles in this business. I refer it out, primarily only if you're self-employed and you're buying a tool of trade. I do not do asset finance. And why would I find it would be absolute paradox if I'm here telling people to buy investment properties, but on the other hand, I'm financing cars to get paid. Like it wouldn't make any sense. If your broker's not living and breathing this, like come on, like do better. If your buyer's agent isn't living and breathing this, come on, do better. And I've got to implore people, if you're not willing to push the boundaries on your team, if you're not willing to ask the questions, the hard questions of them, that's the results you're going to get. Like with all honesty, like if you're spending nearly an hour listening to this podcast and you're going to do nothing with it, shame on you.
I said, nothing against the new cars. They're good. They're really good.
You don't need a new car. Let's be honest.
Yeah.
You do not. A secondhand car will do people just fine, particularly if you're in that accumulation phase of trying to buy investment properties.
And to be honest, I still enjoy my old car.
Oh, dude. I think that's probably where, again, we talk about celebration. My goal is I'll rent a nice car for a weekend.
Yeah.
Okay, no maintenance that comes with it. I'm not neurotic about it getting scratched or whatever, kids jumping in it. I can hire it for a weekend and give it back. My life goes on. And I think that's probably where I'm trying to, I'm trying to keep it real. Like mate, there's policies that allow me to go and buy a vehicle with my ABN registered for as long as it is with the turnover, what it is, to go and buy a $150,000 car, providing no financials. I don't need to provide financials and I can go and buy a brand new car up to $150K. That's crazy. That's how easy it is to go and buy a car. But to go and buy an investment property is bloody hard. Set up the trust, engage a buyer's agent, pay the fees, get the loan set up, get the it's hard. But that's choose your hard, my friend. Choose your hard. Like you said when we came in and chatted this morning, I'm doing a cold shower, 100 push-ups in the morning, meditation. About 100% I'm leading into like this is the hard, choose your hard. Because it's very similar to you, man. Get up earlier, glass of hot water, do my breath work, do my meditation. I'll go to the gym in the mornings. You're saying you're doing 100 push-ups. Yeah. Hey man, this is uncommon stuff. And I'm not saying everyone has to go out there and do breath work and meditation and a cold shower in the morning. But what is the level of hard that you're choosing that's putting you out of the pack, that's going to get you extraordinary results? Because if you're doing what everyone else is doing, you're going to get the same crappy results that everyone else is getting. Yeah. Yeah. And I've got to implore you, if you're spending the time on this, take some action. I'm saying reach out to us. I've got no vested interest in people just reaching out to me exclusively. Reach out to you, reach out to other buyers agents. We don't care as long as people are doing something, right? See,
and as you just said, it's a walk the talk. Yeah. You wouldn't be doing asset finance because you're talking about buying houses. It's all about walk the talk. When clients come to me, I tell them about my experience and it's my team also. My team itself, they also have investment properties. So when they are talking to clients, they're at the same level. They know what they have felt, what they're feeling now, and why is it so overwhelming, and why are they so scared. So that's very, very important when you talk to clients. So that's what we tell them. There's cold showers, there's buying properties. You got to be comfortable in this uncomfortable situation. You got to be comfortable with negative cash flow. Yes. You've got to be comfortable with maintenance issues. You've got to be comfortable with tenants asking for this and that.
You got to be comfortable with paying tax,
Yep.
land tax, capital gains tax. You've got to be comfortable with paying X amount to set up a bare trust or a company or a trust and certifying trustees and paying for legal. You've got to be comfortable with that. And if you're not comfortable with it and you're trying to expect a 1% property portfolio, it's like saying, I'm going to eat chocolate and expect a 6-pack.
That can't be.
No. And that's where I speak primarily to people that if you want it that bad enough, man, you'll find a way. And
Yep.
I think it's probably a really good way for us to kind of just let that linger, let that thought simmer with you. Because I genuinely feel like if you want the results bad enough, you're gonna do everything in your powers to reach out to say, Rishi, reach out to myself, reach out to your broker and go, I'm not leaving. And that's what I say to people. I'll tell people, and I have lost a lot of the ego or like a lot of my arrogance, for a better use of a word. But I would say, I'm not leaving here till we sort this out. I'm not leaving. So if you're speaking to your broker, it's like, I'm not getting off the phone till we or give them a week or whatever it is to work on your numbers, or your buyer's agent. Hey man, I'm not leaving here without clarity on this strategy. I'm not leaving here until we get this sorted out.
Yep.
Like, you've got to actually just go, man, how do I take control of this? Because maybe we get 2025, this is the buying window.
Yep, absolutely.
Mate, rates are dropping, demand and competition will pick up. 2026, mate, property prices will continue to increase. I'm like, we are smack bang in this buying window, and people will look back going, this was a sweet spot to be buying in.
Yep.
Depending on which market you are buying in as well. So, Rishi, thank you so much, man. I appreciate it.
No, man.
You got a good aura about you. I know we've been trying to line this up for some time. So thanks for your patience, mate.
No, thanks a lot.
Like I said, mate, you're here with kind of two hats on. You're here going, I'm here as a property investor. I'm also here as a buyer's agent. Like I said, you're not farming or fishing for business.
No.
But if you are curious, want to have a chat, we'll include details to Rishi InvestorWise as well. And guys, I just want to let that thought simmer. Is like, how bad do you want it? What are you doing to move the needle in your life? And how are you going to take action to move forward? Because we're only nearly halfway through, or past halfway in 2025. There's still heaps of time left this year.
Right, there's still heaps of time. There's lots of markets where you can invest.
Yeah.
There are lots of price brackets that you can go in. There are different growth corridors where you can go to invest in.
Awesome. I love it. Hey guys, drop us a message if you found this helpful. And Eve, I think I'll tell what the other part is. That spreadsheet, I'm gonna as soon as we go back to the office, I'll hit you up on that one.
Sure,
if you want to copy this cash flow spreadsheet, I feel like this is the thing that's going to really open doors for investors. This is the number one pain point I'm seeing for investors, which is, hey, how do I address this negative cash flow? How much is this red line at the bottom of my spreadsheet looking like? Let's have a chat to Rishi and get a copy of that spreadsheet, and we'll share that as soon as you drop us a DM. As always, thanks very much for tuning in. Love to hear from you if you're curious about a loan strategy or a property portfolio roadmap as well. Look forward to talking to you soon. Bye.